You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at @TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Imperial Brands, Britvic, easyJet, Helios Towers, Burberry, and our US company of the week is Nvidia. Sam, shall I kick us off with Imperial Brands?
Absolutely, our second favourite tobacco maker.
And the second largest in the UK. So they had their second quarter results out with underlying half-year net revenues, tobacco and new generation products increasing by 2.8% to £3.6 billion, ignoring the effects of exchange rates. Tobacco prices were up 8.6%, more than offsetting a 6.3% fall in volumes. Revenue from next generation products grew 16.8% to £125 million. Underlying operating profit also rose by 2.8% to £1.7 billion. Free cash outflows worsened from £432 million to £523 million at the period end, and underlying net debt rose by around £300 million to £10.1 billion. And the first half saw around £600 million of share buybacks, with about £500 million expected in the second half. And there were no changes to full year guidance, which is in the low single-digit net revenue growth range. And the shares were up around 1.5% in early trading. In terms of valuation, Imperial Brands has a market cap of £16.75 billion and trades at a forward price to earnings of 6.1, compared with a 10-year average of 9.4. And it has a prospective dividend yield of 8.5%. I thought these results were, they're pretty similar with what we've become used to from both of the big tobacco companies listed in the UK. They're still able to grow revenues, but you look at the volumes and with the traditional combustibles, 6.3%. I know we had seen it higher before, but it's much more significant than it was a couple of years ago when we were covering these companies. And then it was usually sort of between 3 and 5%. But now we're seeing it getting into the higher single digits, and that seems to be fairly consistent. So there is only going to be so long that they can continue to increase the prices. And I suppose it's always the investment case now is really on those new generation products, and then boiling back down to fundamentals and the valuation as to how much cash, whether it's through dividends or share buybacks, they can return to shareholders. And that's what I guess people looking to invest in Imperial are focusing on, because it's certainly, not growth. Very difficult. You see these sorts of valuations partly, I think, for political reasons, in that institutional investors by and large don't invest in these companies anymore, even if they are potentially on paper attractive opportunities because of the ethical concerns. And I think that is, continuing to depress things. If people were looking at it from an investment perspective, it's difficult to see any great re-rating. I think probably a few years ago, so I remember kind of 2016 times, which was probably, I haven't looked at the chart recently, when Imperial Brands and British American were peaking. British American at that time was trading at around between 17 and 18 times earnings. And you can see, and that was times earnings, not forward earnings. So I wouldn't see anything like that ever happening. But I suppose it is that value call on these sorts of stocks now. You could argue, and we've talked about it before, whether there is more growth ahead, particularly when it comes to British American. It's more international. It's got a more rapidly growing and now, I believe, profitable e-cigarette business, which Imperial, whilst it spent a lot of money on the blue brand, hasn't. It's picking up a bit now, but it hasn't delivered the same performance as British American Tobacco has enjoyed. So in summary, I think what we've come to expect, volumes accelerating and next generation yet to be, I think, fully seen, but incredibly, incredibly cheap. Sam, what are your thoughts on these results from from Imperial Brands?
Pretty similar. I think the revenue increase is good. It's what we come to expect. But like you've highlighted, the prices are up a lot and the volume drops higher than historically. So if it carries on, I don't think it'll even sort of stay at 6%. I think it's going to continue to go up, the volume drops.
Yeah.
I do wonder if part of the problem is you've not got that next generation of smokers through because they're going on to the next generation products, some of the people who maybe otherwise would have smoked. So in that sense, the next generation is doing its job. But the problem is that's only grown 16%, and that's off a tiny base. I mean, 125 million compared to 3.6 billion.
Yeah.
I suppose with British American, the next generation is actually a lot stronger. But for Imperial, I think it's a big, big problem. You could argue it's reflecting the share price because it's 50% below the 10-year average in terms of the PE. But I don't know why you'd pick it instead of British American, because I think these volume drops are going to increase. And that's not necessarily a problem if you get enough cash out before then. But I just think in terms of the actual business that'll be left at the end, I think you're more likely to get one with British American, and the prices are usually fairly similar. Maybe British American slightly more expensive, but I think it's worth paying up for a business that has much more of a future. Because I mean, if next generation product carries on growing at 16% and even slowing down as it gets bigger, by the time the combustibles is gone, there'll be nothing left in that business.
Yeah. And you do wonder whether it would be a target, but I suppose the market is already quite consolidated anyway. So
as well, what are you buying?
Well, yeah.
Would British American be looking and being like, let's expose, we've done all this work on the non-combustibles, let's expose ourselves to more combustibles, which we know is declining. I think you would have to get it at a very, very good price. And I don't know if 6 times earnings is actually it, given that the business is buying it already has this massive combustible business that's probably at a similar price.
Yeah. But it's one case that I see sometimes being made for it. So I thought it's worth just putting it out there.
Yeah, I just, for me, I would pick British American every day of the week over Imperial Brands.
Yeah, no, fair enough. Okay, on to I think a healthier business, Britvic.
Yes, so Britvic have come out with their interim results. For anyone who's, we've covered Britvic multiple times, but they have the Pepsi license in the UK. They also have Fruit Shoot, J2O, loads of stuff like that. And then they have a few brands over in Brazil. So they've come out with their half-year results, and revenue increased 11.2% to 880 million. Adjusted EBIT increased 17.7% to 100 million. Adjusted EBIT margin increased 60 basis points to 11.4%. Profit after tax increased 10.1% to 59.9 million. Adjusted earnings per share were up 18.5% to 27p. Interim dividend per share was up 15.9% to 9.5p. Adjusted net debt was up slightly to 2.3x due to an acquisition in Brazil. And they've announced a third buyback program of up to 75 million to be executed in the next 12 months. And that's on a 2.41 billion market cap. They said that volumes were up in the half 4.4%. They've had robust growth with all 3 business units achieving revenue contribution and margin expansion. Standout growth was from Pepsi Max, Ballygowan, Miwadi, Fruit Shoot, and Lipton. Brazil revenue was up 34.7%, driven by both core portfolio and recently integrated energy acquisition. New growth spaces increased revenue by 63.5%, led by outstanding Plenish performance. In terms of the valuation, the business trades at a P of 16 and has a yield of 3.15%. So for context, we covered AG Bar fairly recently. It might have been like a month ago now. Their revenues were up 8%, so that compares to 11% for Britvic. And their profits were up 16%, and that compares to probably about 17% for Britvic. So I think for the first time in a while, these results are actually better than AG Bar's. The Brazil revenue is actually up a decent amount. That's been pretty sluggish recently, but 35% Brazil revenue increase, you can't really complain about. I think this is a really good quarter. I think the last sort of few quarters, AG Bar's probably actually been doing better. The only thing is, because it's been quite sluggish for a while, I would want to wait and see what happens and if they can sustain that Brazil growth. But I think this is encouraging. It's one of the most encouraging things we've probably seen from Britvic for maybe 12 months. And I think if they can continue with these kind of figures, it's very cheap at a P of 16 and with a decent yield. What about you, John?
Yeah, no, I think it's great results. And I think both businesses are very good. And I don't know, I think probably when we first started covering them a couple of years ago, I thought, Unilever much higher quality, and perhaps look down on them a little bit. But gosh, they are doing well, and in terms of the margins and things, also decent. So yeah, I think you could do a lot worse than Britvic or AG Bar, but I think Britvic right now on these results, yeah, slightly better.
Well, it has to sustain it, which it hasn't done so far.
Yeah, no, absolutely.
Whereas
But
AG Bar has had a few really solid quarters now.
yeah,
or halves.
yeah, no, absolutely.
Right. Should we move on to a business that's not been so solid recently, or probably ever in the time that we've covered it?
Well, yeah, and I suppose you can caveat that by the fact that when we started the podcast, it was kind of during COVID, so this company, easyJet, was particularly badly hit as so many flights were cancelled and holidays for the next 2 years at least were heavily impacted. And of course, we had the inflation and cost of living difficulties again. It hasn't been an easy time for easyJet. But anyway, they had their second quarter results out with first half revenue rising 22% to £3.3 billion, reflecting increased airline capacity, increased prices, and higher revenue from additional products, especially the package holiday business. Airline revenue per seat was up 5%, and passenger numbers rose by 11% to 36.7 million. The increased capacity and higher fuel prices contributed to headline costs increasing by 17%. Despite this, pre-tax losses were £61 million lower, coming in at £350 million, and the group generated free cash flow of £227 million, whilst net debt, or the net debt position, swung to net cash of £146 million at the end of the period. The RPS outlook is slightly softer than previously thought, but capacity is expected to rise by 8% in the second half. And the CEO of 7 years, Johan Lundgren, is stepping down. And the current CFO is going to take over the role, with a handover happening in early 2025. And the shares were down around 7% on the results. I think it's really difficult with easyJet. It is reflected, in terms of the valuation. They've got a market cap of 3.66 billion and forward price to book of 1.13. I think one of the things that I learned from Warren Buffett is to avoid airlines, and I think easyJet is a case in point. Incredibly difficult businesses to make money in, huge amounts of capital expenditure required, and there are lots of things that were well outside their control. So higher fuel prices for one, and with things going on as they are in the Middle East, there's going to be, well, you'd expect increased volatility there. And of course, Russia and Ukraine. It's so difficult. And I wouldn't be touching easyJet, really. Obviously good that capacity and things are increasing, but I think as the health of the business and the nature of the business, it's not something I would go near personally.
I'd have to look at the free cash flow statement, which I'm not going to do because I've got no interest in investing in it. I just don't understand how they've managed to lose 350 million but generate free cash flow of 200 million. I wouldn't bother drilling into it because I'm not going to buy it regardless. It's just not worth my time. I just think it's quite interesting that they are so at odds with each other. I think it's a bit of a funny one, this, because on the surface, the results are better. They are getting better. They're moving in the right direction. But if you're still losing 350 million a year, I'd say that's not sustainable. If you're generating free cash flow, maybe it is. But I don't know what levers they've pulled to do that. But yeah, I just don't know why you would want the business, because even if the business was in a healthier state, it's still in such a tough industry. As you've highlighted, it's an industry that historically has been very, very punishing to investors. I just don't know why you'd want the heartache of owning it, because you'd really have to keep an eye on it. And even if you do, I think the best returns would be pretty average for the industry.
Yeah, no, fair enough. Shall we move on to Helios Towers?
Yes. So Helios Towers is a business we've covered once before. It's fairly similar to Airtel Africa in that they operate in Africa. It's to do with like telecoms. However, these guys basically provide the infrastructure rather than the actual end service. They're listed on the FTSE 250 and they have come out with their Q1 results. And number of sites was up 4% to 14,166. Number of tenancies was up 10% to 27,686. Revenue was up 14% to $194 million, and all these figures are in dollars. Operating profit was up 104% to $67 million. Free cash flow was up 21% to $70 million. Cash generated from operations was up 54% to $56 million. Net debt was up 4% to 1.8 billion, and the net leverage ratio dropped from 5.1x to 4.4x. So that's quite encouraging. And they also said, we're delighted to see Moody's upgrading our credit rating from B2 to B1 and S&P from B to B+, driven by the company's track record, diversification and cash flow generation. They've also highlighted that business is underpinned by future contracted revenues of 5.7 billion, and that compares to 4.8 billion a year ago, of which 99% is from multinational MNOs, with average remaining initial life of 7.7 years compared to 7.3 years a year ago. In terms of the valuation, the business trades at a P ratio of 4.74, doesn't pay a dividend, has a market cap of 1.35 billion. I think these results are very good. There's not really anything you can knock apart from the debt, but that's coming down. So they're tackling everything they can, it seems. It's very cheap. I would probably have the same issue I had with it last time. And I think although the results are really good, it probably reflects the issue that we saw last time, where this is because of the nature of what they're doing, where they're providing the infrastructure. It's a very, very capital intensive business. And although the results are looking really good now, you will get very volatile swings. If they have a year next year where there's just a lot of capital expenditure needed, it's just going to absolutely hammer the results. So I think it's fairly justified that it does trade at such a low PE, because when you include as well the issues of where it's operating, as we've seen with Airtel Africa, with, for example, the Nigerian revenue and stuff, you've got that risk as well, but you've just got, I think, this extra layer of risk on top of that, because what they're doing is so capital intensive. So for me, I can see why maybe someone would want to dig deeper into this and might like the look of it, but I feel like I'm getting exposure to Africa as a continent and African telecoms already. I'm not sat there thinking I want to increase my African telecoms exposure. And if I did, I would probably buy Airtel Africa, which I would consider to be lower risk, but still has pretty good prospects of hopefully outsized returns. But I can see why someone maybe might like Helios Towers based on these results. John, what are your thoughts?
Yeah, no, similarly, and I am in a similar position to you where I already own Airtel Africa. It's interesting because they don't actually operate in Nigeria. This is Helios Towers. So I think that's probably one of the reasons that they haven't, been impacted so much by currency. But they do. Tanzania, Senegal, Malawi, the DRC, Ghana, Congo, South Africa, Madagascar, and Oman. So
I wouldn't say any of those are known for the stability of their currencies. Well, even if they've not been as bad as Nigeria.
No, but I mean, we know that Nigeria has had a particularly bad year. So it's probably one of the reasons. I think, for example, if you were comparing the two in the last year, it would probably be a little bit unfair on Airtel Africa. But no, I would have similar views to you on it, Sam, and I think it probably is reflected in the valuation too.
Should we move on to Burberry then?
Yes. So it'd be fair to say we've had mixed views on Burberry. So we've covered it several times on the show before. It's the fashion retailer best known for its trench coats and fancy handbags, not Burberry caps. That was an image that they successfully moved away from over the last 20 years. And it's largely slanted from an investing point of view towards Asia. And that's where it is very popular. And it's where one of the main arguments for growth and investing in the company comes from. Anyway, they have their full year results out, which with full year revenue was basically flat, ignoring the effect of exchange rates, coming in at £3 billion. And again, that was broadly in line with the downgraded guidance and reflected a slowdown in the luxury demand. Mainland China saw weakness in the fourth quarter, whilst the Americas revenue was down 12% for the year. Together with higher costs, it meant that underlying operating profit was down by a quarter to £418 million, and free cash flow fell to £63 million from £393 million a year earlier. And net debt more than doubled to 1.1 billion, with leverage now at the higher end of Burberry's target range. Conditions are expected to remain challenging in the first half of the new financial year, and the group is planning to realise cost savings in a bid to protect profits. A full-year dividend of 61 pence per share was announced, which was in line with last year, and the shares were down 1.6% on the news. In terms of valuation, Burberry has a market cap of £3.7 billion and trades at 15.6 times forward earnings, compared with a 10-year average of 20, and it has a prospective dividend yield of 4.4%. It's definitely, challenging time for Burberry, and I suppose for all retailers, but particularly those ones at the higher end, as things have been tighter and there's been cost of living pressures, and you are seeing that they're not, even at the premium end, they're not immune. And when we've covered LVMH, we've seen that too, and that is obviously probably the highest quality, although the numbers have been better than this, but so is the valuation, much more premium valuation. If you were taking a longer term view, I think it's still a good quality business, and it's an iconic brand. It is in a growth market, and if it continues to remain popular in that growth market, it could do very well. And that 15.6 times forward earnings, if that is true, is not expensive. But I don't know. I probably wouldn't be rushing to buy shares. It's on the watch list, but I think a fair way down at the moment. Sam, fair assessment, or would you be a bit kinder to Burberry?
No, I definitely wouldn't be any kinder. It's just a really poor year. I appreciate we've had cost of living and stuff, but these results are just really poor. I think in the time we've covered the show, it's been very stop-start. You might get a decent quarter, then it seems like any progress they make, they seem to just give it back, and they've done that again. If you go and look at the last 5 years' results, it's not really sort of done anything more than increase revenues in line with inflation over those 5 years, despite all the opportunity that you would think is in Asia with the emerging middle class. That's just not feeding through. I'd be surprised if they hadn't lost market share in the last 5 years based on the turnover figures. And then on top of that, I just think, it's similar to when we covered, which one did we cover? Ralph Lauren a while ago.
Yeah.
I'd have a similar issue where, do you want to pin everything on the Burberry brand? Why? I know you've got to pay up for it, but I'd probably rather own LVMH. I think anyone would rather own LVMH, but you've got this umbrella of just fantastic brands. And if there is a Burberry in there that's not doing very well, you've got a bit more protection from it. Whereas, depending on how popular or cool Burberry is at the moment, his fortunes will rise or fall with that. I'm not sure I'd want it. But that being said, the shares are the cheapest since we've started covering it. But I'd say the business hasn't really changed in those 3 years. So I think if you're buying it, I just don't know what you're expecting it to do, because it doesn't really have a track record of delivering growth. And I don't feel like there's a plan or anything. They're talking about cost savings, and I just feel like I could have maybe opened up the set of results from when we first started covering it. And if you'd read those out, I wouldn't have said, hang on, that doesn't sound, it's pretty similar story. Yeah. And then it's just a bit, I don't know, it's just a bit repetitive, I think. So I wouldn't be interested in it because of that. And, I expect we'll be here in 6 months and it'll have another decent quarter, but it can't seem to put together any momentum.
Yeah. No, fair analysis, I would say. Okay, then. Right. On to, the biggest by far, biggest by all of the companies added together and probably times by 10, Nvidia.
Yes. So Nvidia, you might be able to times by more than 10, actually. Should we have a look?
Go on,
then.
I'll
work it out. So Helios Towers, 1.35 billion. Britvic, 2.41. Imperial, this one will be a bit bigger, 16.76. easyJet, 3.66. And Burberry is 3.72. So combined, 27.9 billion. We'll be generous. We'll round it up to 28. And Nvidia has a market cap of 2.7 trillion.
Bloody
So
hell.
that'd be 2,700, wouldn't it? Divided by 28. So it's 96 times bigger than all the other companies we've covered this week combined.
Gosh.
Which, yeah, I don't think I expected it to be that large when I started plugging them in.
Gosh.
96 times than all the other five. Absolutely insane.
Oh,
But anyway, but then, the biggest stock on the FTSE is only like 100 billion, isn't it? So it's going to be at least 27 times bigger than that. So anyway, Nvidia have come out with their first quarter results and they've beaten market expectations for both revenue and earnings in the first quarter. Revenue was up 262% to $26 billion. The key driver was data center growth, fueled by accelerating demand for its AI-focused computing platforms. Gross margins improved by 12.1 percentage points to 78.9%, which combined with relatively modest increases in operating expenses, allowing operating profit to rise 690% to 16.9 billion. Free cash flow rose from 2.6 to 14.9 billion, and net cash stood at 21.7 billion. Nvidia has raised the quarterly dividend by 150%, 10 cents a share, and repurchased 7.7 billion of its own stock in the first 3 months. There will also be a 10-for-1 stock split in June, which will rebase the share price but has no direct impact on valuation. Revenue in the second quarter is expected to be around 28 billion. Full year guidance on gross margins is for a range in the mid-70s, and the shares were up 6.4% in after-hours trading. In terms of valuation, the business trades at a PE of 34, and that compares to an average for the past 10 years of 35. The prospective yield for the next 12 months is 0.02%, and that compares to a 10-year average of 0.5%, which gives you an idea of how the share price has been doing. Fantastic results. But even when we were talking about it, when you look at that 2.7 trillion market cap, even these figures look really small, I think.
Yeah.
And it's not going to carry on growing 260% a year. It just can't. And I just think, how much of that AI stuff is actually going to be sustainable? Is it going to continue growing the way everyone thinks? Or is this just going to be a bit of a fad like the metaverse was a couple of years ago? Will the AI stuff actually be really useful? But then after a couple of years, everyone's bought it, and they need to be able to move that technology forward to a point where people are like, oh, actually, the AI stuff we've bought no longer cuts it. We need a new AI computing platform. But if these AI computing platforms are going to be good for the next 5 or 10 years because the technology is not going to progress enough, which I don't know anything about AI. But if that is the case, you're going to get this massive drop because it's going to be a very cyclical bit. It's kind of like a games console, isn't it? If you're only bringing a new one out every 5 years, there's certain points in the cycle where it's just going to drop off a cliff. So I just don't know. And then on top of that, it's already so big. I just think, who is paying 35 times earnings for this business at this valuation? And I think the growth actually flatters the value. I think it's a lot more expensive than it is because depending on what happens with the AI, this could drop off a cliff. And we saw that in 2017, 2018 with the crypto mining stuff. I don't think it was the crypto mining stuff, was it? But it was the chips were being used for the crypto mining, the graphics cards. So you've got a very similar thing where it's sort of quite faddy and then it's just sort of fallen off a cliff. Incredible business, incredible performance. I wish I hadn't talked you out of putting it in the fantasy portfolio, whatever it was, 3 or 4 years ago, because that probably would have driven any market beating returns we would have needed. But I just think, who's going out and buying this business today? And just to put it into perspective, it's like, we're talking about, so they repurchased 7.7 billion of stock on a 2.7 trillion market cap. What is the point? It's a rounding error. It's just genuinely, right? If we don't act for any companies this big, but if we were doing a set of accounts for a business of 2.7 trillion, 7.7 billion, I don't know if you'd even bother looking into it. It's that small. You just forget about it. You can lose that amount under the sofa. So just really good business, but I just find the valuation baffling. What about you, John?
It's very difficult to come to terms with the valuation. I mean, it was an amazing company, not one that I really pretend to understand, and it's one that I think you're very I was more comfortable putting in a fantasy portfolio. I never put it in my own portfolio. I wish I had, but no, I'd never put it. Probably would have great difficulty, buying it with my own money. But it's difficult because when it was at, I think when it was about $1 trillion, we were like, bloody hell, how does it even, where does it go from here? And now we're more than double that. But it's very difficult when it comes to all of the AI stuff, unless you have deep knowledge of the industry and you know where you think it's going. To be paying 34 times forward earnings is you'd have to be brave.
Brave's a very polite word, I think.
Well, that's yeah. I think either way you'd have to be brave. Or if you're just purely speculating on it, then you could just be stupid. But
it's that big, it'll be a couple of percent for you anyway.
Yeah, well, I know, and this is the thing, because I've got most of my biggest holdings are MSCI All World Index. So when you look at that and you look at the breakdown, you've got a very decent amount of that in US tech, just because of the size of the business, and in terms of market weighting, they are just that big. So yeah, I will have money in it, in Nvidia,
but not a small amount though. It's actually probably a higher proportion of your portfolio than you maybe would actually like.
I know, but then again, it's driven a lot of the performance of it, but it's one that I'm brave enough to own as part of an index, but one that I certainly wouldn't be as an individual stock. And sometimes it's just by the fact that I'm not looking at that index and looking how heavily weighted some of these companies are. But then again, you would go back a few years and you could have said it about a lot of US tech in general, but they are incredible companies, I think, at the end of the day.
I'm just glad I wasn't one of the people shorting it at the start of the year, because quite a lot of people did.
Yeah, but I mean, that's the same reason that you sort of wouldn't or shouldn't short anything, really.
So of the 6 businesses that we've covered this week, Imperial Brands, Britvic, easyJet, Helios Towers, Burberry and Nvidia, which you like the most and which you like the least?
It's quite easy one for me. I would go for Britvic as my top pick. I think it's a quality consumer goods company. And lastly, I'd probably go easyJet. I wouldn't be comfortable owning an airline.
Without being boring, I would do exactly the same. I don't really have anything further to add.
Fine. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.